Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Rima and Nigel. Guys, good morning.
Hi, morning.
Hi, good morning. U.S. markets shut yesterday, but there's still so much action and geopolitical, tensions right on top.
One successful listing, Nigel, although I think the pipeline is huge, but I think we need... Generally, broadly speaking, for our market, I think we need one set of factors to abate a little bit. We need supply to abate a little bit.
Well, that's right.
And demand to increase a little bit.
On a day-to-day basis, coming to the pitch, and in fact, it's looking all wobbly. You don't know what Trump's doing. Plenty of selling as well out here. And I think that rupee needs to stabilize. I think that's another important mark because the FI selling just continues. A bit of a worry.
Well, I have a very interesting theory on the rupee, which we'll discuss later. Not right now, but I think basically why the government wants the rupee to be weak. I mean, usually it's about exports and how exports become more competitive. But I think, but that's for later. Let me just begin by telling you what you need to know as we begin this new session, right? So U.S. cash markets were shut. Futures is what we have indications from. And U.S. futures were down 1%, 1.25%, I mean, in that range. There was the Martin Luther King holiday, so cash indices did not trade. European equities were all lower. So DAX was down 1.3% by close. The CAC, which is the French market, was down almost 2% or so. And this is, of course, I mean, think about it. It's it's U.S. usually in a fight, tiff, spat with other countries like China, etc. But here, you've got U.S. in a serious spat with European countries. And that security umbrella of NATO at the risk of sort of, disintegrating. We had Ian Bremmer yesterday talking about it. We had Kenneth Rogoff of Harvard yesterday saying, well, in the last 25 years, he's been to Davos. He's never seen Europeans so upset. Scott Bessent, essentially, and this is important, he basically warned European countries against retaliatory tariffs. Remember, Trump is saying 10% from the 1st of Feb, 25% from June, and the tariffs stay till they're able to get control of Greenland. They're able to purchase Greenland. And I mean, European countries have been, there've been lots of reports that they'll put retaliatory tariffs on US imports into Europe. So Bessent saying, well, it'll be unwise. And he went on to say, we're not going to outsource our hemispheric security to anyone else. So that is, I think it's simmering, and we don't know how this was going to pan out. Remember, President Trump is leading a very large delegation to Davos. At the largest ever to Davos. They've got a USA house, as Shireen was showing us from there. And President Trump is expected to speak on the Davos stage on Wednesday. So basically, it'll be Thursday morning when we hear from him from there. Now, just two other things, right? Fed Chair Powell is going to, and this is also in a way historic, he's going to attend tomorrow Supreme Court hearing on Trump's attempt to fire Lisa Cook. It's symbolic, but Fed Chair Powell being in the courtroom in person, in solidarity, as one of his colleagues is being sort of, and this is, of course, related to, she was fired for cause, and the court is going to look at whether the cause makes sense and whether the president has got, ultimate authority to do this. So it's become a bit of a, Trump's attacks on the Fed is not new. He's done it in the first term. He's doing it now. What is new, of course, is that the Fed seems to be fighting back. And of course, we had that, we had earlier Fed Chair Powell himself under attack, and he can sort of fighting back as well. So this is going to be interesting. Now, the other thing later tonight is going to be possible U.S. Supreme Court ruling on Trump's IEEPA-based tariffs, emergency tariffs. So 2 times it's not happened. And it's been a waiting game, but it may come up and the Supreme Court may rule, and then suddenly tomorrow becomes very different and, big. Of course, only if some of those tariffs are at least partially rolled back. In terms of other commodities, precious metals jumped to near record highs. Silver was up 6%. Gold prices were up very, very sharply, about 2% on gold as well coming through. If you can have the prices up. That's that. Bitcoin fell sharply to about $92,000. Almost 92, and then they kind of sort of, came up a little bit. So up right now, the last time I checked. Yesterday, it's been a bad situation, right? I mean, the market's broken through long-term moving averages. The one level that I've been highlighting is the 20 weekly average, and yesterday's close is below it. So the 20 weekly is now 25,684. And that's not a good sign, ultimately, for long-term watchers of the index. Now, the resistance is the closest is you can look at hourly averages, etc. But the 40 exponential moving average is that's the daily average, is perhaps the closest. 25,895 is that level. And the Nifty Bank, it almost got to the 20-day moving average and then bounced. So there is a bit of an intermarket divergence as well. Financials, especially PSU banks, etc., are not breaking down. But Nifty, of course, has broken down. So, but in a way, the silver lining is, if there is this divergence, I mean, it will get corrected one way or the other. Either the banks will fall or the Nifty is going to see a little bit of a recovery. So we'll see. But the Nifty Bank, the 20-day is 59,552. The day's low yesterday on that index was almost there, not quite. And then we saw a decent bounce, and we ended about 1/3% lower. GIFT Nifty gives you a quick sense of where we're likely to start. It's absolutely unchanged, making up its mind as we speak, with about 60 minutes to go for the pre-open. Nigel has walked across with the F&O positioning stats. Nigel, take it away.
Well, today is the weekly expiry as well for the Nifty, so it makes things even more volatile. Let's start off with the flows first. No surprises out there. The FIs, they continue to sell. The DIs continue to buy. And the FI is selling at around 3,300 crores. It's not coming down from that level. And the Indian rupee on a daily basis, we're seeing some kind of weakness intraday. I think some stability is required first in the Indian rupee, and then hopefully we see some kind of a turnaround from the FIs. Moving to what the FIs did on the future space, they added short positions. Both on index futures, they added short positions. Even on stock futures, there were shorts that were added. So we've got shorts in the system. Percentage terms, 91% of the positions on index futures itself is on the short side. So they're aggressively net short. If you look at it in absolute terms, the clients, their long positioning has hit 1.43 lakh contracts. And I was just going by the chart, in the last 10 months or so, we haven't seen this sort of long build-up from the clients. And the FIs, as we've been telling you, their short positioning as well is closer to the upper end of the last few months in terms of the short positions. So that combination is something that normally you like, but of late, the markets itself have got punctured and the structure has got punctured. Moving to the options data, the 25,600 call, aggressive writing is what we saw there. Premiums down to around 50 rupees, while the 25,500 put. Now, this is interesting. Yesterday, it appeared there was writing at this level. The premium has come down to around 40 rupees or thereabouts. So those writers, they'll be looking to defend the lower levels. And a couple of technical indicators, they're moving towards the extreme end. So the RSI on the Nifty is around 37. Remember, at around 30 odd, it gets closer to the oversold level. So that's going to be important. And the PCR as well at around 0.77. At around 0.65 is when it gets to that oversold level. So both these two indicators are gradually moving towards that oversold level. So the structure on the Nifty, that's punctured. However, the 25,450 mark is extremely important. In the last 10 days or so, we have gone to that mark, 25,500, 25,450, in that vicinity a couple of times, and we have bounced from there. An adventurous trader would like to maybe go ahead and take a bit of a punt at around this 25,450, 25,500 mark, just because there's important support out there and because we have bounced off those levels. The Nifty Bank, that'll have to lead the way in case you see some kind of a fight back, because the 20 DMA, that's the first reference point, and at around 59,000 odd, you have the 50 DMA. So that's the important zone. In terms of stocks to track, well, Havells came out with the set of numbers, top line growth pretty good. The problem is in terms of margins, but industry sources are indicating that maybe there's a price hike as well that's gradually getting pushed through that, hurt them in terms of margins in the last quarter. So maybe that's a stock to track. Came out with the set of numbers, management joining later today, one of the stocks that we'll be tracking today.
The only thing with Havells is it trades at 50 times forward multiple, according to Jefferies. So that's 5% above the 10-year average, which is why some analysts have a hold call on Jefferies. But let's get back to the global stories. Lynn Alden, founder of Lynn Alden Investment Strategy, is now joining in. Thank you very much for joining in. Trump, Europe, Greenland continues to be top of mind. Europe sold off 1.5% overnight. Today, the US markets will react. How do you expect this situation to play out? Do you see the tariffs on the 8 European countries going through on the back of Greenland? Will Europe retaliate? What, according to you, in the base case, might be the fate of Greenland?
Yeah, so I think there's a difference between what happens on the next day versus what happens over the coming weeks. We saw over the past year, whenever there were very big tariff escalations, there tended to be immediate term reactions, but then the market generally tried to see through it and assume that there's going to be some sort of de-escalation. It's possible they'll get caught out that time. Maybe there won't be a de-escalation, but I think that the multi-week kind of bias of the market is to try to look through that sort of thing. In addition, at the same time, the country is awaiting a Supreme Court decision on the legality of those tariffs, which is not really a Boolean outcome. There's a spectrum of outcomes there that could somewhat constrain the president's ability to do these kind of like unilateral, large-scale, long-term tariffs. Right now, if you look at betting markets, the market is betting that the Supreme Court is likely not going to rule in his favor. And so base case seems to be some sort of restriction on those. The administration's already said that, should that happen, they do plan to try whatever legal workarounds they can. So I don't think that, by any stretch, the tariffs are going to go away. But I think that there's a mix here that the market is saying, okay, there's some degree of de-escalation that might happen, combined with the Supreme Court just making it complicated and therefore slowing things down to some extent. So I think that gives the market some breathing room, even though I don't necessarily expect this to be a smooth week.
Got that. Lynn, the other one in the courts, not today but tomorrow, is reports that Fed Chair Powell plans to be present in the courtroom when the matter of Lisa Cook's firing comes up. So this is kind of sort of shaping up for the first time, I guess, ever, a proper fight between the Fed and the executive authority. So does that have any implications at all? Markets got pretty used to President Trump attacking and demanding lower interest rates, but they're not used to the Fed kind of sort of standing up and fighting.
Yeah, this is probably the biggest feud between the Fed and the executive branch since 1951, since the Treasury Fed Accord. The only time it came even somewhat closest was the 70s, but that didn't get formal like this one has. I do think that Chairman Powell will finish his term as chairman, despite some of the recent flare-ups. We've already seen a little bit of a de-escalation when Jerome Powell kind of came out with that rather strongly worded response. President Trump, rather than double down on social media, generally kind of distanced himself, saying he wasn't, initially aware of that. There are reports that those in the administration were somewhat surprised by it. There's multiple camps in there. I think the Treasury Secretary is not in favor of a flare-up in that regard. So I do think that, while this upcoming hearing is important, and there is a longer term, kind of trend here of the Fed's independence being in question, my base case is the first half of this year, we don't really see fireworks in that regard. But then as, over time, as more members are added, as we get a new chairman, I do think we have to watch for signs of ongoing reduction in independence. I don't think I think it could potentially affect interest rates later this year. I think their balance sheet size, is already in a gradually expanding mode. And I think that's going to continue pretty much regardless of the FOMC makeup in the quarters ahead.
Hi, Len. Good to see you, Ben. What about the equity markets? You have mentioned numerous times you like LATAM. And you've been positive on those markets like the Brazilian index. And if you look at that clutch of markets, actually, they've done well. Commodities have seen a melt up. Even smaller markets like a Chilean market, because of their exposure, the country's exposure to copper, has done very, very well. At current reckoning, post India's underperformance, where do we fit in the pecking order?
Yeah, so over the past year, I've been pounding the table in Latin America, and they outperformed broadly last year. While I'm still bullish on Latin America, I still think there's room to run in the years ahead. I think we're in a multi-year, not a linear market, but I think we're in a multi-year bull market for many emerging markets. I do think that 2026 is potentially a better year for India. I am more bullish on Indian equities than I was last year. After that period of underperformance, I think the valuations are now more favoring of India. As you already point out in your program, there's some technical damage in Indian equity markets. So I would encourage traders to wait for whatever technical signals they prefer. But I would say that the fundamentals are getting more supportive. And so if a technical trigger should, kind of indicate that some degree of a bottom is in, I think there's better odds of good Indian equity performance this year than last year.
Risk reward in favor of India right now. Lynn, thank you very much for joining in. Let's also tell our viewers all the interactions that we've lined up on the show today. So first up, 8:35, the management of CEAT will join in to discuss the company's Q3 numbers. Very strong 60% jump in the company's profitability. 9 a.m., Renu Baid of IIFL Institutional Equities will put the spotlight on the capital goods sector. 9:20, JP Morgan, Sanjay Mukim will be a market master for the day. 9:30, the management of IRFC will join in to break down the quarter gone by. Following that, the management of PNB will be joining in at 9:40. We'll also be speaking to the management of Hindustan Zinc on the December quarter numbers. At 10 a.m., we'll get you another earnings conversation with Yes Bank's Prashant Kumar. And finally, towards the end of the show, Lata will discuss budget math with economist Sonal Verma of Nomura, Pranjal Bhandari of HSBC, and Upasana Bharadwaj of Kotak. And Voices from Davos, we bring you a conversation with HCL Tech C. Vijay Kumar, Cognizant's Ravi Kumar. Stay tuned for that.
Time to slip into a short break. We've got a lot of stock-specific action to track for you. We get to that in just a bit. For the time being, I give you a sneak peek. LTI Mindtree, Havells India, Tata Capital, CEAT, UPL, Raymond Lifestyle, and Bajaj Electrical. They're all going to be on the back of positive news flow, while you have AB Lifestyle brands, AB FRL, as well as Oberoi Realty that will be reacting to negative news flow. Take the break, come back, we get into further detail on all of these names.
Welcome back. You're watching Bazaar Morning Call. It's time now for CNBC-TV18's list of top stocks for the day. To prep you up for this Tuesday morning, our entire research team is standing by and in the midst of a heavy earnings season. So let me kickstart this one with LTI Mindtree. LTI Mindtree numbers were largely in line with estimates, and it was a good quarter. The company's top line went up by 2.4%, similar to the growth rate that we had in the prior quarter. Margins expanded by 20 basis points to 16.1%. Profits were impacted on account of the one-off labor code impact, which is why profits went down 30%. But with respect to what the company said in the guidance, they said they aim to achieve near double-digit year-on-year revenue growth in Q4. In Q3, margins expanded, as I said, to 16.1%, but there is a wage hike impact which will kick in Q4 and Q1. The company is spreading it out over 2 quarters, so they will try and offset that on account of efficiencies. But overall, they said that they hope to end FY26 with better margins. All in all, a steady quarter by LTI Mindtree and in line with expectations. But what about Tata Capital? The Tata Capital. Gaurav now joins in to tell us how the numbers fared. Hi.
Well, if you look at Tata Capital numbers, they were actually better than the street's expectation and also in line with their guidance, or in fact a bit better than the guidance, because if you look at AUM growth, that came in at around 26% on a year-on-year basis. If you look at the guidance, they were guiding for 22 to 25%. In fact, for FY28, they are actually guiding to this growth to be 23 to 25%, and this will also include the motor finance. Other than that, if you look at the numbers, net interest income and PPOP both were up 10% on a year-on-year basis. Now profits that increased almost by 15%. It was a bit lower than their own guidance of more than 35% growth in terms of profitability, but they have stuck to this guidance for FY26, showing some kind of confidence on the increasing profit going ahead. Apart from that, the asset quality also remained very strong. In fact, the credit cost, which also includes the motor finance, which was a pain point for Tata Capital, now that has come down to 1.2%. Remember, the guidance was of 1.2% for FY26, and in fact, going ahead, they're expecting this credit cost to come below 1%. Other than that, if you look at ROAs as well, they are now at 2.1% versus their own guidance of 2 to 2.1%. So again, at the upper end of the guidance, and going ahead till FY28, they want to achieve ROAs of 2.5 to 2.7%. So all in all, the numbers are good. Overall, the outlook is good till FY28. And on the back of that, we will definitely watch out on this stock today.
Okay, all right, Gaurav, thanks very much for that. Well, Upasana is here with details on Havells India. Upasana, take it away. Morning.
Good morning. Well, in-line set of numbers as compared to our estimates, revenue and margin is largely in line, while there's a slight miss on the PAT due to an exceptional item of 45 crores. Now, if you look at the cables and wires, they have seen a strong growth of nearly about 44%. Now, overall revenue has seen a growth of 14% in line with estimates, which was led by the strong growth in cables and wires. Cables and wires revenue has grown about 33%, which was driven by volume expansion and even commodity price inflation. Now, if we look at the direct player, that is Polycab, it has shown a 46% growth here as compared to Havells, which stands at 33%. Now, coming to the margins, margins are broadly stable. The EBITDA margin has seen an uptick of 60 basis points at 9.4% versus the estimate of 9.7%. Now, as I mentioned earlier, the exceptional item of 45 crore was a one-off impact due to additional provision on account of new labor code, which impacted the profit, which is why the profit stands at 301 crore with an uptick of 6% on a YoY basis. Now, company says that the demand has remained modest during the quarter with a festive season uptick, but uneven consumption trends is what they are saying. Now, looking at the key positives is certainly the cable and wire demand and the revenue growth here, which has exemplified a strong volume and value growth. Also in ECD segment, the revenue has seen an uptick of 4% on the back of good demand for heating products. Now, looking at the key negatives, that is the company's lighting revenue was impacted down about 4% with the shift in the festive season this year. And also Lloyd remains in focus as the Lloyd performance continues to remain muted with the impact of a weak summer, and the losses have also widened in this segment. So all in all, going with a mild green, but the stock might slip into red on the back of the weakness seen in the Lloyd consumer.
Okay, all right. Thanks a lot for that, Upasana. Well, hopping across to Sonal. She's tracking Oberoi Realty. Morning, Sonal.
Good morning, Nigel. Well, Oberoi Realty reported numbers today, and if we look at their operational performance, their bookings were down 36% on a sequential basis. They were up 6% on a YY basis to come in at 836 crore rupees, but the volumes were disappointing too, down 28% sequentially and down 70% on a YY basis. The same quarter last year had some launches coming in from Thane, and that's why it does look sharply lower on a YY basis. But the company says in 2026, they will continue to actively pursue attractive land opportunities, and they remain optimistic on the year ahead because of their launch pipeline and capital management as well. Additionally, they say it's the luxury segment which is drawing a lot of interest from buyers, and these are in established locations, largely from HNIs. So the commentary is positive, but their internals look quite weak.
Okay, all right, Sonal, thank you very much. Well, CEAT, the company we're going to be speaking with in just a bit. Let's get the numbers out of the way. Sudarshan, take it away.
Good morning, Prashant. So it was a good set of earnings for Q3 FY26 in the environment where there was an increase in the raw material cost both on a sequential basis as well as YY, and that impacted gross margin as well as realization. But overall, the numbers look good. Revenue profit has increased by more than 60%. Revenue saw a jump of 26%. EBITDA too saw an increase of 66%. Margin has managed to hold on to the levels above 13%. It has come in at 13.5% versus 10.3% the same period last year. And the demand growth company is saying it's mainly because of the increase or recovery in the international business, and also the recent demand uptick that has been seen in the replacement segment that has helped both revenue as well as volume. So I'm going with green for CEAT.
Okay, well, as I said, so thanks very much. The management joins us on the third quarter numbers. Arnab Banerjee is going to be with us in about 10 minutes' time. Well, Vivek is here. Lots of block deals, AB Lifestyle, AB Fashion. Vivek, take it away.
Well, that's right. So we're expecting, recently large-size blocks in two Aditya Birla Group companies today. So as per our sources and as per the term sheet we managed to access last evening, the first one that you're looking at is Aditya Birla Lifestyle Brands Limited, an undisclosed institutional investor looking to sell up to 3% of the total equity. Total size of the block is around $43 million, close to 400 crores. The floor price for this particular block is at 106.1 rupees a share, a little over 8% discount to last close. This is a clean-out trade from this particular institutional equity investor. The other stock, of course, with Aditya Birla Fashion and Retail. Similarly, again, an institutional investor is looking to sell close to 3% of the total equity. Block size are slightly smaller, $32 million. Floor price at 65.7 rupees a share. Again, almost 8.5% discount to the last close, and it's once again a cleanup or a clean-out trade. So it'll be interesting to see, number one, who the seller is. We did try and look through the shareholding patterns. So most of the large earlier investors have exited, but it'll be interesting to see, number one, who's the seller, and also in the details that come out in the evening, who are the buyers or who participate in this particular block.
Thank you very much for that. Back to Sonal now on UPL.
Well, UPL will be on our radar because their subsidiary Advanta Enterprises has finally filed for a DRHP with SEBI, BSE and NSE. They say it will be an offer for sale of up to 3.6 crore shares, out of which UPL will be offering 2.8 crore shares in this offer. Now remember, Advanta is a subsidiary of UPL where UPL holds 64% stake. UPL Corporation, that one holds 14% stake, and Advanta is into the business of seed solutions for field crops, vegetable crops and oil seeds. This was something which the street was watching out for. Now remember, in terms of financials, Advanta did revenues of 5685 crore rupees in FY25 with profits of 921 crore rupees. Even the first half of FY26 has been strong with 3100 crores of revenues and 540 crore rupees in terms of profits. So this is the next trigger, but of course we'll need more details in terms of the valuations and other aspects, but UPL should be in focus on the back of this.
Okay, all right. Thanks a lot for that, Sonal. Well, let's wind this down then with Vinny on other stocks in the news. Hey, Vinny, morning.
Hi, good morning. So talking about Raymond Lifestyle first, positive news after they've appointed Satyaki Ghosh as the new Chief Executive Officer of the company. Ghosh is joining from the Aditya Birla Group. He was heading one of the divisions of fashion yarn business in Grasim Industries. He has over 25 years of experience in FMCG, textile, retail and consumer business. Do not forget, Raymond Lifestyle as a business, post its, demerger from Raymond, hasn't been doing that well. It's seen a fair share of ups and downs. So this new CEO expecting better strategy coming in for the company, and given his experience, hoping there will be some positive move here. Raymond Lifestyle also recently, do not forget, had onboarded EC Prasad as the CFO, and he will take charge from the upcoming board meeting as well. Next one, Bajaj Electrical, some positive news here as well. So green expected here after the company has entered into wires segment, which is a new business line for the company. This will be in their lighting solution segment. The growing demand in wire segment is the main reason that they have looked at entering this segment. It's a strategic decision that they've made. So green expected on both these things.
Bajaj Electrical is a stock down 40% in the last 1 year. So will this move boost the prospects? And also keep your eye on restaurants brand Asia, because there is a board meeting today to consider a fundraise. And will we hear more on Vivek's story about Everstone's plans to sell their 11% stake? So that's a stock also you should keep on your radar. Thanks, guys, for running us through this list. Here's a quick recap then. Stocks with positive news flow are LTI Mindtree, Havells, Tata Capital, SEAT, UPL, Raymond Lifestyle and Bajaj Electrical. Stocks with negative news flow are Aditya Birla Lifestyle Brands, AB Fashion and Retail and Oberoi Realty. Well, that's equities. What about commodities and currency? Manisha now joins in with a complete roundup. Manisha.
Well, thank you so much for that. I'll start with the crude oil prices first, where we're looking at prices almost holding their gains, especially with the U.S. and the friction that we've seen between U.S. and Europe for that matter, with Europe also now saying that they can come out with the anti-coercion measures there. Remember, it's nearly $10 trillion of bonds and treasuries that these European countries hold of U.S. And if the trade dispute intensifies, then this perhaps could be leveraged, and that is what is making the markets jittery at this point in time. Safe haven buying has continued, so whether you look at gold, still holding around that $46, $70 an ounce mark, or it's about silver, we've seen $94.50 an ounce of an all-time high. It seems to be holding around $93.50 at this point in the Asian markets therein. There is a lot of data that is coming in from U.S. this week as well. You have the GDP numbers coming in, and the consumer sentiment will tell you on where the markets will take a further direction from. What has seen a profit-taking, though, has been base metal prices. So whether it's about tin, which fell 7% overnight, or copper, aluminum, zinc, all of that has seen a decline. This comes in the back of Shanghai telling some high-frequency trading firms to abstain from the market, keep the volatility down and the speculation down as well. And that has led to some profit-taking across board.
Tin has been on Manisha's mind, right, Manisha?
It has been.
Talking about, well, I think, we'll see you in office, Manisha. Thanks very much for joining us with an update on commodities. We'll take a quick commercial break. SEAT is the management we'll be speaking with on the third quarter numbers. Stay tuned, coming up. Okay, well, here's another exclusive from Davos, the World Economic Forum. After stabilizing its operations over the last 3 years, Cognizant is shifting gears towards aggressive growth strategies, AI and outcome-based pricing at the forefront. My colleague Shireen caught up with the CEO, S. Ravi Kumar, to talk about all of that, but of course also about a potential secondary listing, Cognizant here in India. Listen in.
I would say the first 3 years was about stabilization, and the next 3 years is actually going to be about bold bets. In the first 3 years, we climbed up the charts, and on relative scale, till the end of Q3, which we have publicly announced our earnings, we are on the upper quartile, top performance on relative scale. So I'm very happy with where we are, but looking forward to the next 3 years, which is going to be big bets and bold bets.
You did publicly state that you are looking at the possibility of a secondary listing or an IPO in India. Where have things progressed on that front? How close are we to an actual decision being taken?
So, Shireen, we are working with the regulators in India. The last time something like this happened was many, many years ago when Standard Chartered did this. Right now, we will be the first company who is attempting this, which means we have the burden of actually helping the regulator to work alongside us to get to the finishing line. So that's a journey we have to go through.
How close is the finishing line?
Look, regulators in India are very receptive for new instruments. This is an American listed company which has the opportunity to list in India as a secondary listing. That's what Indian companies did in the 90s. They actually listed primary in India and then they went to the US.
Yes.
We think we have a pool of investors in India who are very keen to invest into tech services. Tech services is a proxy for AI. We also think there's a lot of mutual fund money which is being fed from the middle class of India, the vibrant middle class of India. We think we can capture that opportunity for Cognizant and get a new category of investors. It's going to be a journey to do this, but we'll give it a try.
And what are the questions the regulators are asking?
There are a variety of things because this is the first time we are doing it, but they are in a constant dialogue and we are iterating, and it's very constructive. So I'm very pleased with all the meetings we have done.
And do you think 2026 could be?
Hard to say. These are things which is very hard to say, but we're going to give it a try.
Okay.
Okay, interesting. We'll keep an eye out on that. For the time being, let's turn our attention to the auto ancillary space because CEAT reported a healthy set of numbers in Q3. The margins hold on to levels around the 13%, while increased raw material costs, that's dented the gross margin a little bit. To discuss what happened in the past quarter and how are things shaping up, we're joined by Mr. Arnab Banerjee, the Managing Director and CEO at CEAT. Hi, Mr. Banerjee. Good morning. And good to see you in today and wishing you, your team, all the best for 2026. Well, Q3 appears like a good one in terms of growth. And as I'm looking at your mix, replacement is a large part of your business. So could you tell us the trends that we saw in the past quarter? Are they expected to continue? And if you could help us out with what is the volume growth you're targeting for this year and the next?
Well, past quarter has been good. I think after the GST revision in the month of September, initially we saw trade downstocking, but it's all come back. And there is a good sentiment in both OEM and replacement market in the domestic area. We have seen mid-teens to high teens kind of growth in replacement. And we have had a base effect of OEM. Our last year base was a little bit lower. So good growth in OEM as well. And we'll have to wait a while, maybe a couple of quarters to see if this kind of impetus continues. Because Q3 usually is a weak quarter for us because of the onset of winter in north and east. It has broken the trend because of these changes primarily. And that's why we have brought forward our investment plans in passenger car tires as well, as you know.
Right, let's talk a little bit more on that then. You're looking to add close to 35 lakh tires per annum. And that capacity is expected to come on stream in the first half of FY28. Break it down for us. What would that be in terms of the total capacity addition? And how do you fund it? I think you've earmarked close to around 1,300 crores. So the breakup between debt as well as internal accruals?
Well, yes, the capacity, we will add about 35 lakh tires through the year. And overall capacity after this addition will be about 60,000 tires per day So you can multiply that by 350 days to get the annual capacity. And this will service primarily all segments, replacement, OE and IB. The expansion is coming up at Chennai, which is a brownfield expansion. So we don't expect too much of uncertainty there. It will be funded by a mix of debt and equity. Our ratios, as we see going forward, will be well within our internal control limits. The debt equity currently is at 0.6. Debt EBITDA is also around 1.5, 1.6. So we don't expect to worsen those equities too much, as we have been regularly incurring capex, if you have seen over the last few years. And so it will be the capex guidance for the next few years also will be similar as a percentage of sale.
All right, just one thing, sir. So you'll be at roughly around 2 crore capacity then. This is roughly around a 15 to 20% increase in your total capacity. That should be a fair estimate, right?
60,000 per day. Yes.
Yeah. All right.
Mr. Banerjee, good morning, sir. Prashant here. I had a slightly, top-down question, but I think it's important because, credit, and my starting point is credit growth. Credit growth was 16, 17, 18%, and it fallen as low as 8%. Now it's back at about 13, 14%, right? I mean, when you look at where this credit growth is going, autos is right up there. In terms of right, and this is instant injection of liquidity. So this is credit growth is equal to sales, pretty much, right, 1-to-1. Are you getting that sense that this could be? I don't think expectations from auto companies that we speak to is of anything great. Maybe better, etc. But is it possible, as credit growth picks up and continues to move higher, driven by all these policy measures, this turns out to be a pretty we see a meaningful upside surprise in terms of auto volumes. Is there any sense in your interactions with OEMs?
Yes, I think, there was a structural change in the four-wheeler auto sales where we see the emergence of SUV, when the first-time buyers going straight to the SUV, leading to value growth. But the volume growth was muted in terms of number of cars. Post the GST, that thing has changed, because the small car volumes have come back. So that means larger number of tires, of course, but we'll have to wait and see whether the structural change towards consumer preference of higher vehicles, bigger vehicles, the SUVs, is going to come back. But the overall numbers are definitely going to increase. How much, we will have to see for the next 2 quarters. Two-wheelers and farm are going to see a secular growth, because we have seen the growth momentum coming back more from the smaller towns. So we believe that these are still, two-wheeler is an underpenetrated category still, and there is scope for growth in terms of number of vehicles there. And because of the credit growth which you mentioned, we have seen a bounce back in the commercial vehicle segment as well, which is truck and bus. And this was kind of not growing in the first half, nor was passenger in terms of numbers. So these growths have come back to, yes, it has been bullish, but we'll have to see a couple of more quarters to see how much sustains.
Mr. Banerjee, time for just one question. So let me squeeze in 2 quick ones. One, what percentage of your overall revenues or volumes go to the US? I know it's small, but can you give us a number? And on the back of the punitive tariffs, what has been the volume in Q3? And what is the outlook on margins for Q4, given the way rubber prices have panned out and the currency depreciation?
So I'll answer the US question first. Less than 3% of our turnover goes to US. And as I had been maintaining in the past, for us, it's important to get a toehold in terms of creating the distribution and logistics infrastructure in US. So we had been absorbing the tariff impact to a certain extent and passing on by certain extent. That strategy continues over Q3 and also Q4. We have not seen any drop in sales turnover, therefore, to the US, though it remains small, and impact on bottom line is muted. We see this as a very big growth market, so we stay invested in US. So that's the US part. No impact on bottom line, but we are setting it up for growth in future. Overall margins, if you see, standalone margins have inched up from 13.7 to 14.1% in this quarter because of higher turnover and growth. We expect the raw material situation to be flattish in Q4, maybe slight inflation of max up to 1%. So mostly flattish, maybe slight inflation. That is the kind of situation. By end of February, we will see an uptick in volumes, the seasonal volumes, which kicks in for the period of March to June, the summer volumes. So we expect the margin, overall margin for the company to move in similar zone.
All right, very quickly, sir. Your net debt is around 2,930 crores. Does this number stabilize around this mark? Because you've got a capex as well that's lined up. And would it be fair, going by your commentary and the capex that you're adding, that you will be looking at growing at least at mid-teens for the next couple of years?
Value growth this year, I can say, will be close to that, because first 3 quarters, as per published results, you can see we have grown by mid-teens. So we want to continue that trend for this year. Next year, it's too difficult to predict, 2 years at once, but we are laying the foundation, as US is one of the growth measures. We are laying the foundation for domestic growth in terms of OE approvals, as well as replacement channel expansion, especially on the premium side, which is the SUV side. So we are planning for at least double-digit growth going forward.
Mr. Banerjee, we'll leave it there. Thank you very much for joining us. Good speaking with you. And thank you for being here. We'll take a quick break. We're back. Mayuresh Joshi is going to be with us, Director of Research at Mark Smith India, for some fundamental stock conversation. We'll address some of the other results apart from C8 with Mayuresh as well. Stay tuned. Okay, welcome back. 15 minutes to go for the pre-open session to kick off. Mayuresh Joshi is with us. Mayuresh, good morning. Just a pretty weak market, right? Breaking through some long-term averages on the Nifty yesterday. If you have a brief comment on the index itself, the Nifty, and there's a bit of a divergence. Bank Nifty has not even broken short-term moving averages. The Nifty, of course, is looking much worse, I guess, because large stocks like Reliance, etc., have been very weak. So just a quick view, if you have it, and then we'll move on to some results reactions.
Morning, Prashant. I think we've got a unique way of mapping this through distribution days as we see it in Markets with India. And those distribution days are actually inching up over the past few days and weeks, which is a very inherent sign that the pressure for the market probably continues. For a whole host of factors, primarily based in terms of how geopolitics is shaping up. And you're absolutely right. I think how the bank numbers have played out so far are probably emanating in terms of the bank Nifty probably doing well. Reliance was a decent set of numbers, yet I think the street probably reacted negatively yesterday. And therefore, I think we still believe that you probably should have a very sector and a stock-specific approach as you approach these markets.
Any results stand out to you from last evening? C8 reported, Havells, Hindustan Zinc, so many, right?
Absolutely, Prashant. So I think C8 was a decent set, in my opinion. Havells disappointed to a certain extent. And in fact, one of their comments in the press release, it might be an eye-opener for consumer durable plays generally in Q3. That statement was that the demand remains probably modest with very uneven consumption. Cooling products, small appliances have seen pressure. Channel inventory was normalizing. And therefore, I think as input costs are heading higher, specifically copper prices, as you see, aluminum prices, as you see it, it's a pass-through, no doubt, but I think it probably increases the end product prices, even post-GST rationalization, which probably makes it a little bit of a concern from an immediate short-term perspective. Hindustan Zinc expected numbers were expected to be good. And therefore, I think how prices probably move in the coming quarter as well will largely determine how numbers will play forth in Q4. But in my opinion, again, I think decent set by both C8 as well as Zinc. Havells largely disappointed.
Okay. Hi, Mayuresh. Good morning. Good to see you in. What about UPL? They're looking at unlocking some value, post the issue that they're likely to come out with. We're still waiting by in terms of valuations. But that's been one of the underperforming stocks, if I look at it over the last few years. Value is there, trades at a discount. But do you think you could gradually start getting positive on this name?
Morning, Nigel. Yes, and in fact, we've added that stock into our momentum portfolios. Our own sense is that outside the deal, if you probably look at the basic business construct that UPL operates out of, the expectations in terms of demand remaining steady should be a base case scenario. Obviously, I think expectations in terms of key input costs have largely remained benign, which probably makes us believe that margins, specifically on the operating front, should largely start holding out. And the key markets that they're now probably operating out of, that should show signs of resilience as we head into the next few quarters as well. So our own sense is that the basic EPS growth should start going up as we head into the next few quarters and exit FY27. That number might be far better than what we probably see in exit 25. So yeah, remain optimistic on this one.
Sun Pharma, Mayuresh, I mean, others have reported, we've also reported, and there's some news that they've made a non-binding offer of a very large $10 billion acquisition in the US, Mayuresh. Have you looked at the details in terms of what it gets them? Usually large acquisitions, people get very, very, very quickly. But basically, if they're able to pull this off, revenues double pretty much. Your thoughts?
No, you're right. And therefore, I think the whole scenario is the matrix that you built in as a base case and a bull case scenario. And therefore, from a bull case perspective, I think the numbers might look phenomenal. However, I think when you probably just have a constrained approach and look at the base case scenario and the existing business model, assuming that if this does not go through, I think they've got a few key molecules in place. A few of their molecules are going through phase 3 trials as we speak. And therefore, I think the monetization of these critical FTFs that Sun is expected to file and monetize thereafter might lead to significant amount of organic growth that they're driving themselves. Now, outside that, what probably happens in terms of the Organon Pharma acquisition might start adding up in terms of value as we head into the next few years, in terms of both synergies and new markets that probably open up, specifically in key areas and critical areas at that, where margins are relatively higher. That probably lays a case for a bull case scenario. From a base case, I think they have plenty up their sleeve, but they've also got concerns related to FDA and what they probably do with that as well. So I think it's an if-but scenario at this point of time. On our watch list, but not necessarily added to our portfolios.
All right, Mayuresh, want to ask you about Interglobe Aviation. Not going to ask you about your experience if you traveled off late, but I want to ask you your view on the stock. It's corrected a goodish bit from the top. There were a couple of penalties that came out. And yesterday, going by the stock price move, the street believes they're getting away easy with regard to this in the quantum of the penalties. What's your take? It's going to be the leader. The number 2 is far away from them. But post this correction, would you be positive?
I think the swing might be there, and you're absolutely right. I think the quantum of penalties that got levied on Indigo, I think far lesser than what the street probably believed or expected Indigo to probably get in terms of monetary penalties or otherwise from the regulator. And therefore, I think you probably saw a reaction onto the stock as we speak. However, from a structural perspective, I think when you probably look at the listed space outside Interglobe, I think SpiceJet has a basic fleet that you probably got. They're expecting to add 8 to 10 aircraft as we speak, as a read from media reports. But generally, I think for the industry as a whole, the kind of purchases that even Air India is making or Vistara is making, or even SpiceJet, I think those deliveries might probably get delayed. And therefore, I think as we speak, the existent dominance in the skies still remain with Indigo. Pricing, again, when we are probably heading into a peak season, how the regulator probably caps prices obviously becomes a risk concern. But ATF prices, which are 45% of the input cost for any airline, still remain benign, which gives them that added cushion in terms of the kind of numbers that they're probably posting. The expectations in terms of available seat kilometers and adding of new routes probably adds to that element. So there might be a momentum that might continue with this stock. We have not added this, or it's not part of our portfolios as we speak.
So many more things to discuss, Mayuresh, and hopefully we'll be able to do that. We'll thank you for now. Appreciate you coming on and sort of running us through your views on a bunch of names there. and hopefully, markets perhaps stabilize a little bit in the next couple of days. Well, let's talk about the big movers in terms of both price action and volumes yesterday. Hormuz is here with that list as always. Hormuz, take it away.
Good morning, Prashant. And earnings reactions, more importantly, earnings casualties were the ones that dotted yesterday's trading session. You can't not talk of Wipro, RBL Bank and IDBI Bank. All of them saw significant price action in yesterday's session. Wipro was down almost 8%, and delivery-based selling was almost 1,600 to 1,700 crore in yesterday's session. You saw almost 7 crore shares traded on Wipro. The 20-day average is only 70 lakh shares. Even for RBL Bank, 2.5 crore shares were traded, almost 4 to 5x its 20-day average. And for IDBI Bank, the numbers were higher than its average volumes as well. Even on the delivery front, almost 50% of Wipro's trading volumes were marked for delivery. Same, almost a third of RBL Bank's volumes as well, close to 80 lakh shares. For IDBI Bank, almost 90 lakh shares were marked for delivery. So a delivery-based selling seen in all of these names in yesterday's trading session. An outperformer yesterday was Jindal SAW, is an earnings reaction as well. The top gainers on the Nifty 500, the biggest single-day gain since January of 2020. The stock before in the last 9 sessions has declined in 7 of them. So this was one of an outlying session yesterday. Volumes on Monday were the highest on record for the stock. Almost 12.5 crore shares were traded yesterday. The 20-day average is just 12.5 lakh shares. But out of those 12.5 lakh shares traded, 12.5 crore shares traded, only 79 lakh shares were marked for delivery. Here, the 20-day average is around about 6.5 lakh shares. And the stock, though, has been an underperformer, still down around 40% from its 52-week high. And the other outperformer in yesterday's session was JSW Infra. And after the management's guidance, it was only the second day of gains for the stock in the last 10 trading sessions. The biggest single-day gain since March of last year. Volumes were the highest since May of last year. Over 1 crore shares were traded yesterday. 20-day average of just 10 lakh shares. And out of those 1 crore shares traded, 25 lakh shares were marked for delivery. The 20-day average being around 6 lakh shares. The stock made a 52-week high of around 350 rupees, down around 22% still from those levels.
Take a break. Hormuz, thanks very much for that. We'll come back with the pre-open rates in about 5 minutes or so. Sudarshan Sukhani will be with us, and so is Mitesh Thakkar with trading ideas. Stay tuned. Coming up.
Welcome back. In a short while from now, in a couple of minutes, we'll get the pre-open rates. For the time being, let's welcome Sudarshan Sukhani, proprietor Technical Trends, as well as Mitesh Thakkar, President Retail Research at Bonanza Portfolio. Good morning, gentlemen. Good to see you all in. Well, the last few trading sessions have been weakish, to say the least. The structure on the Nifty as well appears to be a little bit punctured. However, today's weekly expiry, and yesterday there was some fight just in the last 90 minutes or so, if I could call that a fight. Sudarshan, you go first. What's the trade on the index?
Yeah, good morning. The trade is to stay away from the index. There is no sign that the market is bottoming out. There is no sign that this is a buy on dips opportunity. The market is the Nifty is steadily moving down. It has to stop falling. That's the first step. So that will require a day or 2 days. So irrespective of what the markets do intraday, I think the best trade is not to watch the Nifty and to focus on stocks.
Yeah. Absolutely. And Sudarshan, what would those stocks be on your radar today?
Well, it's a mix today. Fortunately, some buying ideas also, including Ashok Leyland, where a buy is possible with a stop under 185. National Aluminium, a buy is possible with a stop under 360. I have 2 intraday shorts. Bharat Forge, sell with a stop above 1440. And Mazanan Docks, sell with a stop above 2480.
Got that. Mitesh, good morning. What would your call be? Index first?
Yeah. So Prashant, on the index, I maintain that getting past 25,950 is the only way we can possibly negate this setup which is turning weak and gain some strength. Till that happens, I think sell and rallies is a good idea on the index, and I think on the downside, 400, 350, 330 is my preferred zone. So most likely we should test those levels in the next few sessions. And the better indices between all of them, I think, is Nifty IT, which has recently started gaining strength. So maybe you could focus on IT names. Once the Nifty IT manages to get past 39,500, 550, I'm expecting 41,000 plus levels there.
Okay. In terms of single stocks, Mitesh?
I have a mix of buys and sells. A buy on L&T Mindtree LTIM. That's a buy with a stop at 6355 for targets of 6530. Infosys is a buy with a stop at 1663 for targets of 1720. A sell on Bharat Forge with a stop at 1437 for targets of 1370. And a conditional sell on Aurobindo Pharma if it breaks the pivot of 1160, 1155 zone. Then sell with a stop at 1175 for targets of 1115.
What about the big boy, Mitesh? Reliance Industries. It was managing to defend those lower levels, and then yesterday it had a bit of a breakdown. Now it's important that it gets back above those technical levels. I think 1450 or thereabouts. What's your view on this name?
Well, I think, the bigger thing which happened was that 3 weeks back, the stock was on a verge of breaking into fresh all-time highs at around 1585, 1590 levels. And I was hoping that we'll get a weekly closing about that. That has been negated. I think on the medium-term charts, I think the stock is having very strong support around this 1360, 1350 zone. So maybe around those levels, you will see some kind of consolidation and then a reversal.
Yeah, that's a big one, isn't it? I mean, you need stability there for the index to start to maybe stabilize a little bit. The other, Mitesh, the other names, MRPL, Chennai Petro, HP, by the way, we'll probably get out. JP Morgan has downgraded their view on HPCL. And any thoughts on the other oil and gas companies?
Well, I think, what is honestly very interesting to me are the charts of Oil India and ONGC. So Oil India, had a big rally from 405 to about 465, has given a pullback to around 435 levels. I think this 428, 425 zone is very important support area. So if it can hold that, I think a retest of 465 could happen. Similarly, on ONGC, I'm waiting for a big breakout if there's a weekly closing about this 250 to 255 zones. This last week, we had a move till about 251, and then the stock is retraced. But once it breaks 255, I think it could be a stock which would gain some good traction on the medium-term charts, and a target of around 280 can be low.
Got that. Thanks very much, both of you, Mitesh and Sudarshan, for joining in. More later. Appreciate it. Let's talk about the brokerage calls of the day. We're going to focus on Dixon and Godrej Consumer. So take it away.
So Investec has come out with a note on Dixon Technologies. It maintains buy call but has cut target price to 15,000 from 18,900 rupees per share. It says that stock has corrected 40% last 4 months due to certain uncertainties. And those uncertainties are first, delay in obtaining government approvals for Vivo and HKC's JVs. Second, slowdown in consumer demand, especially for mobile segment. And that's the reason it has slowed FY26-28 EBITDA estimates by 5 to 14%. And now stock is trading at 40 times FY28 estimated EPS versus 60 times that it was trading at 3 to 4 months ago. But in its estimates, it's building in company receiving approvals for Vivo and HKC JVs in next couple of months. And those approvals will provide comfort in both revenue growth and margin going forward in FY27-28. Next, Macquarie has written on Godrej Consumer. It has upgraded the stock to outperform and target is 1,400 rupees per share. It sees market share gains in high margin insecticide segment and pickup in soap margin. It expects steady pickup in Indonesia performance in FY27, and it has upgraded the stock because of increase in the EPS estimates in the range of 4 to 5%.
Thanks very much. So very interesting calls there. More coming up in just a bit. Thanks for now. Renu Baid is with us, Senior Vice President, Research at IIFL Institutional Equities. Renu, good morning. Great to have you back on the program here. Thanks for your time. Let's just dive straight in, right? CG Power first up. What's the view and what's the call here? Bit of a bounce yesterday after the data center order, etc. But generally, it's been tough. Last time we spoke, right? I think the one thing we perhaps did not address is this very sharp rise in the price of copper and how that is essentially going to impact margins across the board, not just for CG Power. So why don't you start there?
So for transformers of the grid equipment market, mostly which is catering to the government sector utilities, their price variation clauses are there. So inflation impact of copper CRGO is broadly captured in. Where it gets impacted is the short cycle industrial businesses where it is a function of demand supply dynamics and there is a lag in terms of taking price hike for LT motors and other products in the market. So to that extent, companies with varied exposures will have different impact. On the grid equipment side or transformer companies like CG Power, power equipment should be broadly covered for the cost inflation element of the business. On the industrial, there will be a continued pinch on the margins front, even in this quarter as well, basis our expectations and forecasts for 3Q26.
What kind of companies get impacted? Just as an example, illustration.
So if you look at the names of the industrial segment for CG Power, ABB, Siemens, will have impact on account of the inflation impact in copper. There is a lag in terms of passing on the price increases. Demand environment generally in the short cycle business has been relatively soft. So it becomes difficult to make the entire price transmission in one go. Similarly, companies on the pump side of the business will have similar impact. For most companies which are exposure to government sector contracts, especially the grid utilities, will be able to pass on the cost increases there.
Got that. Yeah, how are just CG as a business you cover the stock? Are valuations attractive now, Renu? What's the call?
Valuations, I think after the recent correction definitely is in a value zone, we think, though not absolutely cheap, but given the growth drivers which are there in place. So CG itself is a cost leader when it comes to power equipment on the transformer side of the market. They have nearly doubled the capacity, plus a new greenfield plant for transformers is due for commissioning in October 26. And we have already seen order book accretion, seeing substantial growth to fill up capacities for these orders. And last order which they announced last weekend, the 900 crores orders from the US data center market, is more important for the company that it not just reinforces that the export focus is there, but entry into private sector customer, that too for the US market, which is a relatively difficult market for companies to enter from the domestic Indian space, has been to the credence of company. So to that extent, the incremental capacities which are coming up are targeted towards export market and domestic market, where it will be able to capture a higher share of the domestic business there. So we see this as quite positive for CG as entry in the US export market, and also with incremental capacities, they're confident that in the fourth quarter of the current year, they are already L1 on a couple of large orders for domestic private sector TVCB players. And order accretion for the power equipment business will remain fairly strong for them. Industrial is going through its own down cycle. It has bottomed out in our view, but growth would be subject to how the private sector investments or capex improves over the next couple of quarters. So there, both revenue growth as well as margins will continue to lag. And power segment, in our view, would be the key growth driver of the company, the way we have seen over the last 1.5 years.
You know, the wire and cable companies, I mean, I think this copper price is just passed through, right? Straight up.
Yeah.
But some of the other segments, like for Havells and others, get impacted as well, but I guess to a lesser degree.
Right. So if you look at the FMEG market, cables and wires, over the years, the market has matured enough in the housing wires to pass on the price increase in LME copper prices on a fortnightly basis, and even at times on a weekly basis where prices are very sharp increase. And there we have seen channel upstocking being very strong, both in the results for Polycab as well as Havells, which came in the last 2 days. For other FMEG products which are facing, say, consumer products, say fans, where inflation impact is there, lighting, switchgear, there the market itself has been fairly weak. Consumer offtake is weak. There is increased competition. And inventories is still elevated for all summer seasonal products. So be it room air conditioners, or the fans ECD portfolio, there the price increases have been with a lag. So the impact on the profitability or margins of these companies, Havells, Crompton, would be very clearly visible. It will take time, probably a quarter or two, till we see demand uptake coming back, and then the price increases would be passed on.
I see. So on the other consumer products, perhaps the impact is a little larger, fans, etc., right? That's what you're saying.
Right. Plus, there is a table change impact, rating change, which has come with effect from Jan 26 for both fans as well as air conditioners. This implies almost anywhere between 5 to 7% price increase. In case of RAC, there was also GST rate cut reduction. So to that extent, the net impact for the consumers would be negated. But in case of fans, definitely price hikes of 5 to 7% would be visible through this calendar year to start with.
Renu, do you have coverage on Hitachi?
No,
Okay.
we don't have formal rating there.
Okay. G, Vanova, etc. also no, right?
No, yeah.
Okay. But any views you can offer otherwise? I mean, because we've seen sharp corrections here.
Corrections have been there in the space because generally if we see the grid equipment market had seen both the prices and margins had been very sharp uptick. Companies are in the phase of having cyclical high margins, price mismatches or the demand supply mismatches are very glaring. Companies are reporting almost 20-25% kind of EBITDA margin. In case of Hitachi, the order wins for HVDC have been very strong. So valuation somewhere for these companies had also increased very sharply, anywhere between 60% to 70% 1 year forward. And what we have seen is after the recent where we had seen an instance that government approvals for TBA came through for reactor as a category. So that became more of a sanity check that sooner or later competition from, even if it's come from domestic Chinese OEMs, will be back in the market. And prices anyway ought to correct in the next 12 months. I see the increment capacity addition in the transformer space coming through. So to that extent, we think the price correction or the valuation correction for these names is fairly justified.
You know, there was this other thing which I think we've not really, but that's Jensen Huang of NVIDIA at that in Vegas at that conference, the big conference. He kind of outlined, he introduced this new product where he said that it could be. I mean, basically, data centers can be completely liquid cooled. So a lot of the equipment required, and I mean it's not just these guys, but I guess a lot of other ancillary. But it'll take time to show up, right? I mean, there's lesser requirement of all of everything else if it's going to be completely liquid cooled. At least that's the claim which he made. But we yet to see, any impact of that on the Hitachi, GE, etc. globally listed as well. And I don't think we've had much impact. Perhaps we'll have to watch. Renu, you're also one of the few analysts who cover NetWeb. So again, a stock which has fallen sharply from the highs, a bit of recovery now after the good numbers. What's the view here?
So here I would say NetWeb is very well positioned for the national AI mission projects that have come through. They have nearly 2,100 crores plus of orders, of which last quarter they already executed 450 crores worth of projects, because of which we saw revenue growth all being pretty strong, 800 crores of revenue for the quarter. So here I think the company has positioned itself very well in terms of domestic manufacturing and giving local solutions for AI data centers as well as for hypercomputing solutions. And when it comes to some of the sovereign infrastructure, they are at the front to claim their share of business. We expect almost 50 to 60% wallet share for them of the 10,000 crore opportunity on this sovereign AI infrastructure over the next 3 years. And next 2 quarters, we will see that kind of jump in execution. And hopefully after budget, some of the other orders which are due for awarding will see acceleration. So at least for this company, we are fairly confident that they should be able to grow 40 to 50% revenues on the base business. And given the localization content that they have and relationship with global partners, both NVIDIA for GPUs as well as other OEM partners here, they are better placed in terms of managing some of these supply chain disruptions that we have seen, be it for the memory chips or for the other components on the electronics value chain. So here also the growth outlook and the earnings front is fairly strong. We expect nearly 90 rupee of EPS for the company in fiscal 28, which would be almost 2 times plus, 2.5 times from fiscal 26 projected earnings of 40 rupees.
2.5 times, 27 over 26 basically, Renu, you're saying.
28, we are forecasting about 90 rupee of earnings over 40 rupees in 26. Over 2 years,
2 years.
We are expecting more earnings, than 2 times,
Okay,
earnings
got
to
that.
double in 2 years.
Got that. And I think we're now starting to look at FY28 estimates, right? I mean, in terms of valuations, etc. So that is that. Thanks very much, Renu. Appreciate you joining in. It's always a pleasure and good speaking with you across a range of companies that you cover. We'll just get 9-10 calls out of the way. Sudarshan is back with us. Sudarshan, what do you have?
Ashok Leyland, buy Ashok Leyland with a stop under 185.
Ashok Leyland from Sudarshan. Mitesh, what do you have?
I'll go with the sell on Bharat Forge.
Sell on Bharat Forge. Got that. Well, just going back to the capital goods space, BHEL, right? Winnie's got more details. She's joining in. Winnie.
Hi, good afternoon. Good morning. I mean, BHEL, obviously, in terms of numbers, it was a okay, weak set of numbers that came in from the company. Now, on the back of that, we have brokerage notes that have come in. Kotak Institutional Equities has maintained the sell rating. They've cut the target price from 125 rupees to 120 rupees. They've cut that FY28 EPS target estimates by 15% as well. They're building a lower pace of execution, modest cuts on gross margin estimates as well. Now, Macquarie too is maintaining the underperform rating. Target price is 205. They said revenue was in line with their estimates. Execution uptick is something that they're seeing, but margins, that was below estimates. And order intake, that was a bit of a positive surprise that came in there. So they believe there is still some bit of an improvement one could expect in terms of revenue visibility.
All right, well, right on cue. Markets are opening. Vinny, thanks for that. 50 points lower on the Nifty, 25,535. So it's sideways. And it's about a 40-odd point cut. So 114 points lower on the sensex. You've got mid-cap index down a quarter, small-cap index down about 0.25%. The Nifty Bank is down about 0.13. I mean, compared to the Nifty Bank, of course, has been much stronger. And it's not yet, for example, broken the 20-day moving average, whereas the Nifty is now at a very long-term support levels. It's actually broken some long-term support levels even. 25,550 on the Nifty is where we are at. So Nifty heat map gives you a sense of where things are landing at open. SBI, Kotak, Tata Motors Passenger Vehicle, and those are the names on the green side. Asian Paint, Shriram Finance, Apollo Hospitals are opening lower. It's more down than up, but it's more evenly balanced as opposed to what we had yesterday. So a little bit of recovery, but just, I mean, the first 1 minute, 27, 25 points lower on the Nifty is what you have. I think keep an eye out on RIL, which is in the red, but I mean, the market needs that one to stop falling at least before it, turns around, because big weight and big say in the index. Yesterday got to almost about 1,400 and, a little bit of bounce, 10, 15 rupee bounce from the day's low is what you had yesterday. Rima.
IT once again is under pressure. Wipro's the top loser. This is after losing 8% yesterday. Wipro's down another 1%. Along with that, you've got Tech Mahindra, Infosys, HCL Tech also opening up with mild cuts. ICICI Bank is seeing some follow-on selling pressure. Yesterday, 2.5% lower. Today, it's lost another 0.5%. Asian Paints is now coming up as the top Nifty loser, so that's down nearly 1%. Shriram Finance is weak in trade. Apollo Hospitals is starting the day with some cuts. Interglobe Aviation is correcting some of yesterday's 4% gain. Bajaj Finance weak in trade. But again, there is no Nifty stock with a loss more than 1%, barring something like an Asian Paints, which is also down just 1%. On the way up, it's SBI, Kotak Mahindra Bank, up and about. Hindalco, so a couple of metal stocks are having a good day. In fact, if you pull up the Nifty Metal Index, perhaps that's the one where we are still seeing some gains. The Nifty Metal Index has opened out with a gain of about 0.5%. Hindalco, JSW Steel, higher in trade. Tata Steel giving it company. On the automotive side, you've got an Eicher Motors, Tata Motors, Passenger Vehicles, M&M. So that's the other pocket of strength that's visible when you look at the frontline action. But again, the action is in the individual stocks.
Well, that's right. ABFRL stock down close to around 7%. That block that take place out there. You have AB Lifestyle as well. That's down close to around 1% or thereabouts. BHEL, that's down close to around 1.5%. It's rather large volumes out there. And Oberoi Realty, that stock is getting a bit of a slam dunk. That's one of the top losers in today's trading session. Hindustan Zinc, we'll talk to the management in a few minutes from now. Remember, in fact, that one came out with a set of numbers. The numbers look pretty okay, a little bit better than what the sheet was anticipating. But the good news is that Q4 will be even better because pricing is higher, so they'll get a better benefit out there. Dalmia Bharat, we've been highlighting this, that cement demand has been improving and some of those price increases are gradually getting absorbed. So it explains why Dalmia Bharat as well is up close to around 2% and SAIL as well is up close to around 1%. Now, yes, there's been a big spike up in terms of steel prices, but the street is optimistic that there's more to go because still at current reckoning, prices are a little bit of a discount in comparison to the landed cost of imported steel. LTI Mindtree, that one's losing close to around 5%. Net, Nifty down, but not out. The Nifty Bank actually is doing a relative outperformance in the first few minutes. Prashant.
Absolutely. It's about 2:1 down, 2:1 in terms of declines to advances ratio. And the broader market, of course, has seen a fair bit of, it's taken a fair bit of beating, actually. Now, LTI Mindtree, I think we highlighted 5% lower, is the number 2 volume-led loser right now on the NSE. Shriram Finance is seeing a bit of a pullback. So one-way move. Before the deal, after the deal, I mean, you name it. 1.6 lower. It's got volumes in it. BHEL, we were just talking about that with Winnie, 1.5 odd lower. Oberoi Realty, we highlighted with numbers 5% down. Force Motor is down about 2%. 361, I think there was a downgrade from someone yesterday. 2.5 lower, 1140 or so on 361. Data Patterns is down about 2%. Sai Silk, that is Kalamandir, is down 6%. That's about 121 or so. Urban Company is down about 1.7. Poonawalla, Sobha, Shakti Pumps. Shakti Pumps is now under 700. Oh boy, I mean, it's a one-way kind of a move, and now, of course, it's from high was $1,000. Actually, the recent low was about 550. So from the recent lows, it's still higher. From the highs, of course, it's lost a fair bit. I started with silver this morning, and look at what's happening once again. Silver B's 4%. We should have these at the bottom of the screen. All these silver ETFs, right? HDFC, SBI, everything up 4%, 5%. So populated really by what's happening on this one. Bharat Coking Coal, and Nigel has been telling us about this, 42, so 4% again. And it's actually, after Silver Bees, it's the number 2 volume-led gainer on the NSE. So huge volumes. It's I guess, it's also the, matter of the fact that it's a more biteable name, right, at 42 rupees. So perhaps that participation is there. GMDC is up 4%. And I think I can spot Vedanta, which is up about 1.5% as well. So enough and more, which is going on right now. Sanjay Mukim is with us, Head of India Equity Research at JP Morgan. Sanjay, good morning. Great to have you with us here. Thanks for joining us. At the turn of the year, especially towards the last week of 25 and first week of 26, I mean, general consensus was that 26 perhaps turns out to be a little better because, earnings perhaps will pick up. What's the earnings season been like so far? I know it's early, but we've got some bellwethers who've already reported. Does it look like we'll see a turn for the better, earnings-wise, Sanjay?
Good morning, great to be on. I think the good news is that the pace of earnings downgrades that we had seen around June last year has abated meaningfully. Earnings expectations for the market are relatively okay, at least for the FY26 season. I don't see you'll see any more downgrades. FY27, Nigel, you might see a little bit more cuts because I think expectations are still elevated. I think consensus is still somewhere around 16%. We think you'll probably end up more in the 12s or 13%. But the challenge, of course, is that it's not just the absolute that matters, it's the relative as well. Because when you're talking of, let's say, the low double-digit potential earnings growth for large caps in India, this comes in contrast with higher growth elsewhere in other sectors around the world in Asia. And you're looking at, or at least talking about, further potential currency weakness as well. So if you were to adjust the growth in dollar terms, then you'd find that in India, you would probably looking at mid to high single-digit dollar return on or dollar growth in earnings for the next 12 odd months. And this contrasts with at least expectations of higher earnings elsewhere. And which is why you see this tone of, oh, nothing's happening and things are slow. I mean, they're not really slow, they're okay. But it's just the contrast of growth elsewhere being much higher that causes this tone in India, I think.
So, Sanjay, 2026 will be another year of India underperformance vis-a-vis the rest?
And the way we've pitched it is that, look, you'll get, at least in the first half of the year, material momentum in other parts of the world. There is possibly fiscal impulse both in the large economies of the US and in China. We're still upgrading our GDP numbers in these countries, for example. So at least in the near term, that phenomena is likely to continue. Second half of the year, and it's very difficult to take these long views now given the heightened uncertainty. Maybe if some of these excitements turn, that India may end up being a little bit of a safe haven. But at least in the near term, it looks like the momentum in economies elsewhere is probably going to be a bit stronger.
Okay. Hi, Sanjay. Nigel on this side, and good to see you. And as always, the call we had around, say, 3 months or so ago was that you were wanting to shift towards consumer discretionary and maybe rotate out a little bit out of capex. That's played out pretty well. At current reckoning, though, getting into a budget with hope that maybe, in fact, the government will do something, what's your current positioning? Will you still be tilting towards the consumer discretionary, or do you think post this recent correction and a couple of these capital good capex related names, it's time to have a relook out there?
Hi, good morning, Nigel. I think no. This is because, look, from a budgeting exercise perspective, we think that revenue collections are weak, and revenue collections will probably remain under pressure for government for a while. And this is, of course, part driven by the lack of inflation in the economy, and also because of the tax cuts that the government has, passed through recently. And I don't think that there is any impulse within policymakers to expand the deficit or think of an aggressive fiscal measure just yet, right? Why use that bullet given the heightened uncertainty everywhere? So that mathematically leaves you little room to accelerate the aggregate capex numbers. And therefore, I think that, yes, even though the sector has sort of been under pressure for a while, I don't think that there is anything that will help it turn around, at least from a public policy point of view, and nothing's clearly in the budget is likely. So on the other hand, the feedback we're getting on many of the consumer discretionary categories, top-down data is looking better. RBI consumer confidence data is improving. Nielsen data is getting better. So there is continued momentum on consumer, especially consumer discretionary, I suppose, not so much on the capex stocks.
Okay, all right, Sanjay, then do you think from here on it will be difficult for these companies to actually make a comeback? And I say that because 2026 could probably be the only budget that they could, look to spur this kind of capital expenditure. 2027, we have, a couple of big state elections, and then you're heading into another, election in 2029. So do you think for the next few years, actually, this consumer theme could actually playing out after the capital-related names had their day in the sun for the last 5-6 years on?
I think the answer, if it's limited to public expenditure, is relatively clear. There is little room for that to accelerate anytime materially. And I would say for, let's say, FY28, etc., the bigger issue would be for government to accommodate the expenditure on the pay commission increases, right? You don't want to be overspending now. You want to be conservative today to create fiscal room to expand, to absorb that additional spending that is predictably coming, right? So the only way your government could increase expenditure is by expanding the deficit, which I think is very unlikely to happen in the near term. So what we could argue maybe is that non-government capex should maybe increase because the government's creating some room by cutting down on deficit. The crowding out effect is going down. We are more, or at least we think that translates more to a real estate momentum sustaining rather than for corporate capex numbers to start to surprise. So I would argue that yes, it's unlikely that public expenditure improves, and that may translate into slightly more sustained real estate spending.
Okay.
Sanjay, so basically it is just retail holding up demand on one side, right? And everybody else is on the other side. Across desks at JP Morgan and your other, your colleagues, etc., is some of that pressure easing off in terms of the supply? QIBs and, promoter stake sales. I mean, just when you look at the pipeline and anecdotally, is some of that easing off or not yet?
Prashant, if you were to add up the reported listings in the market and people who are working on and what constitutes the pipeline, it does look like fairly elevated even for this year. And remember, what happens is that many people don't even advertise their intention to sell stock. If stock is going up, you'll suddenly see an overnight block come in within decent size next day. So a lot of these things tend to be opportunistic as well. If the market does hold up, if the liquidity does hold up, I think that supply will be fairly large in 2026 as well. I don't see that easing up on itself. Yes, of course, if flow goes down, markets ease, then the supply itself will dissipate also.
So far, we've had quite a few geopolitical flashpoints just in the first fortnight of 2026, whether it's Venezuela, questions about Fed independence, Greenland, but markets globally have shrugged it off, saying that it's perhaps going to de-escalate. In your base case, is there a possibility that we see a deepish global correction, which again throws markets off track completely in 2026?
Well, I think that's a fair question because, look, what surprised all of us over the last 4 or 5 years is that you have seen a whole round of these uncertainty drivers globally. Yet equity walls have not only remained low, but they've actually fallen further. And the equity market simply saying that, look, I don't care about all of this. We don't know how to forecast or anticipate many of these issues. I focus on the earnings and earnings momentum, and we stay, let's say, comfortable in that zone. And this is not what I would have predicted 5 years ago. If you'd forecast the situation today, I would have argued that walls will be much higher than they are at the moment. Is there something that can now happen that changes that view from investors? I mean, it can, right? The whole trade war took people by surprise mid last year. Something as big as that, maybe a roll down of the whole AI sentiment, these things can matter. But frankly, given what we've already seen in the market not reacting, I don't know what else nudges it.
Oh, yeah, absolutely. At an index level, global volatility. And Rima, I thought you were going to ask that. You said, will global markets feel the pain? Misery loves company. I don't know. I think we've been suffering alone. But look at the market, right? It's gone. I mean, 100 points lower now. And sellers are back. So 25,484. And I just look at the contrast, the Nifty Bank here. Nifty Bank is down about 0.17. And here, I mean, it's all relative, of course, but this is a little bit of intermarket divergence we were highlighting. The banks index is not breaking down. The Nifty, of course, has broken some of the longer-term averages as well. Sanjay, we'll leave it there for now. Thank you very much for coming on. Appreciate your time here on CNBC-TV18. It's always a pleasure.
Pleasure being on. Thank you.
Okay, well, we've got earnings. We are on an earnings treadmill. Lots of numbers. IRFC, first up. Rima.
Indeed, and they've reported a good Q3. The company managed to achieve its full-year sanctions guidance of 60,000 crore rupees, and they managed to do that just in the first 9 months of this fiscal year. Manoj Kumar Dubey, Chairman and Managing Director of the company, will now join in, and what we'd like to discuss with him is that now what is the disbursement target for FY26, the outlook and trajectory on net interest margins and the opportunities beyond Indian Railways. Mr. Dubey, thank you very much for joining in. Let me begin with the new guidance on sanctions. Now that you've managed to achieve your full year guidance, what can you end FY26 with in terms of sanctions and even on disbursements? Can you share a number?
So good morning, Rima. So we have come out with good numbers as expected. We embarked on our 2.0 journey, that is diversification journey. We started sometime in the March last year. And this 3 quarters have really been gratifying for the company for the fact that we could live up to the expectations and the kind of guidance and the target that we set for ourselves. As you mentioned, by the end of Q3, we have already crossed the mark that we set for ourselves in terms of sanction of assets. So obviously, anything which comes in Q4 is going to be more than what we had given the guidance. Giving a number, I mean, now that we are not thinking of giving any numbers, but rest be assured that since we are looking into B2B kind of system where our ticket size is not less than 5,000 crore for one of the assets, so going forward, if we are able to mop up 2-3 more assets in this Q4, the numbers may be going to be crossing 80,000 crore or something like that. So far as our disbursement is concerned, as you know, we started with zero pipeline in the beginning of the FY. So 30,000 crore target that we had given to ourselves was a very tall target. I'm happy that by the end of Q3, we have done already around 22,000 crore. So that target remains intact, that we believe that by the end of the Q4 and end of the FY, we'll be crossing the bridge of 30,000 crore that we had given to ourselves.
All right. Hi, sir. Good morning and good to see you in as always. What about the AUM? The AUM, I think, is at around 4.7 lakh crore.
As you know, AUM, as you know, this time we had a leap ahead and we ended up at 4.75 lakh crore, which is all-time high for the company. And as I've spoken in the past also, going forward, because in diversification mode, we are getting a very good response. And going forward, every quarter, we believe that now that we have shown a very handsome jump from 4.6 lakh crore to 4.75 lakh crore, this AUM will be showing a quite rise in every quarter going ahead.
So give us a number, sir. Where do you see this number going? And tell us a little bit more about the diversification strategy. As you said, it's being accepted well. So how does the mix look like going ahead?
Oh, yes. So the mix, as we have already discussed, in the diversification mode, we are looking more on the assets on the railway ecosystem. Yes, nearly 3 to 5% of my total assets will, by the end of the year, will be from diversified mode. And next 5 years, we have set a plan that our mix should be something like 60-40. So 60% should be my mix from the pure Indian Railway business, and 40% of my assets would come out from the railway ecosystem. We had a very good exposure to Gencos and Transcos in power value chain. We are not looking for any discom assets. Next to that is we mopped up quite a few number of disbursements in railway ecosystem with our siblings like DFCCIL and many SPVs of the railways. Apart from that, we are having a very close coordination and discussions with port assets as well as the metro railway assets. Maybe 26, 27 FY will be finding that apart from the big ticket assets in these areas, metros and urban transportation will be one of the mainstays where we'll be having a good forays. So overall, as you mentioned, and the guidance that we are giving to ourselves as well as to the interested investors, that going forward in next 5 years, we are looking forward to something around 30 to 40% of diversified kind of asset, where our margins will be 2 to 3x of what we get from the railways. So this 60-40 is something we are looking forward to, ensuring that everything is coming from the whole of government approach, government ecosystem, and we are very particular about looking for the assets who are fitting in our framework of zero NPA.
What will this mean for your net interest margins? Can you give us an indication of the NIM guidance for IRFC?
You see, Rima, already from 1.4 that we used to maintain last year, we are already in 1.5 overall. And going forward, I have been repeatedly saying that the new business on diversification mode, whatever we are getting, here the NIM is more than 2%, 2 to 2.5%. So if you add this to my static NIM of 1.4 that I get from the railway business, it is going to grow. This year, we should end up more than 1.5 for overall. And I believe that going forward, every year, we believe that 1.6, 1.7 and nearing to 2% when we have our nearly 40% of diversified asset in the portfolio will be there. So to give a indication to you, every year, this NIM is going to improve now for the fact that diversified business is going to stay in our kitty.
So when will you achieve 40%, that 60-40 diversification that you intend, which will help to get your NIMs to 2%? How long will it take?
Well, that target we have unveiled as 2030. So next 5 years, that is the target. And we are looking forward to, in fact, 20 potential customers in government ecosystem, each around 15,000 crore. So the roadmap for the company going ahead is that we should look forward to nearly 20 entities in the government ecosystem, having linkage with the railways, and around 15,000 crores should be their ticket size in 1 or 2 or 3 assets together. So going forward, if today I'm having a asset size of nearly 4.75 lakh crore, if you go on net basis, 2030 we are targeting that our mix should be 60-40 in this ratio.
I know you focus, sir, on reducing your dependence on Indian Railways, but can you tell us what is expected from the railway capex side? There is a union budget coming up. There is talk about a very large capex number. What have you heard, and what does this mean for IRFC? And will you require additional capital to meet that?
So you see, Rima, now that we are not on single client mode business, so we are not very, very jittery or anxious about what is coming in the railway budget or the union budget. Yes, we remain the sole financing arm for Indian Railways, and as and when they require any extra budgetary resources, we are there. What I understand from the discussion that is going on is extra budgetary resources going forward, we may not only be directly by the railways. There is a lot of PPP kind of thing that is government is thinking of, and if there is PPP projections also in the railway ecosystem, we will be there to pitch in and see to it that whatever is required for the concessionaire entering into a concession agreement for long term with the Indian Railways, we are their financing partners. So overall, yes, one thing is very clear, that the appetite and requirement of capex for Indian Railways is not going to be less than 2.5 lakh crore for years together, maybe 5 to 10 years. Now, this 2.5 lakh plus crore of capex, whether it is being spent directly by Indian Railway through government budgetary support, or it will require extra budgetary support from our side, or there will be PPP element, that is to be seen after the budget is announced. But rest be assured, in the whole mix of the things, whatever capex requirement is there over and above the government budgetary support to the Indian Railways, it is IRFC which is going to pitch in up.
Okay, thank you very much for that, Mr. Dubey, for joining in. LTI Mindtree has taken a big knock today, 6% down. And this is despite the company reporting fairly decent numbers and in line with expectations. There is no miss when you look at LTIM's top line growth of 2.4%. The company's margins in Q3 improved to 16.1% versus 15.9%. And the company also said in the conference call that towards the end of Q4, they're hopeful to end with a near double-digit year-on-year revenue growth. The only thing is that in Q4 and Q1 of the next 2 quarters, there will be a margin impact, the wage hike impact on the company's margins, which the company will try and offset. But moving on now to PNB. Yesterday, the stock sold off, the bank sold off on the back of slightly disappointing NII growth and a compression seen in the NIMs. Ashok Chandra, MD and CEO of PNB, is now joining in to discuss their Q3 numbers. And we'd like to ask him if a deposit rate cut is likely to protect NIMs, if the loan book growth can sustain within the guided range, and if a 1% ROA is sustainable in the event of rate cuts. Thank you very much, sir, for joining in. First, let's talk about your NIMs. The street was hoping that the NIMs would be stable in Q3, but they declined further. What is the new guidance on NIMs for the full year? Where are you likely to end by Q4 FY26?
The NIM contraction which you are seeing, the impact is because of the 2 reasons. One is that 25 basis point cut which has happened in this particular month, December. And that has also put some impact on our overall NII and the NIM. Second, mindfully, we have not reduced the interest rate on deposits. This was a conscious decision of the management and the ALCO. And we were holding to the same deposit rate for the entire Q3. And since we were seeing the visibility in the good profit and the net profit, operating profit, so keeping in mind the dynamics and the depositors' interest in mind, we were holding to the same deposit rate now. But we have revisited in the Q4 and the very first month of this quarter. We have recalibrated our deposit rate in the various segments and around 20 to 30 basis point cut, which we have done. And definitely, I think that will protect my NIM in this particular quarter.
Okay. So just a level, 2.6, is it for the full year? Should we look at 2.6?
It will be for full year, as of now also, we are at 2.73. And I'm expecting that definitely between 2.6 to 2.7 will be the year end. We will be closing at that level. So somewhere between this margin, between this level, we will be holding it to our NIM.
Okay, 2.6 to 2.7% to end the year with. So Q3 margins would be a trough. Yes. And would you look at a deposit rate cut to improve margins? What will drive this NIM improvement from Q3 to Q4?
One is that our some high cost deposit which we had mobilized in the last 1.5 years, I think 70% of that has already been recalibrated, and 21% we are expecting that will happen in this particular quarter. See what happens, the repricing has already happened, but the impact which we will see in subsequent quarters. So all those things and with some 20 to 30 basis point cut which we have already done in the month of January, definitely there will be NIM positivity will be there, and we are expecting that from now onwards, definitely there will be positive sign in the NIM growth.
Okay, got that. What is the credit growth guidance? Are you still holding on to 11 to 12%? And what is the sanction pipeline now?
Yeah, in the beginning of this financial year, we had given the guidance of 11 to 12%. And as of now also for the full year, we are at 10.9%. And this particular quarter, it is almost around 11%. See, we have already 3.12 lakh crore corporate loan book sanction we have done in this financial year. Last year for 24-25 full year, our sanctioned corporate book was 2 lakh crore, which we have already surpassed. And in that 1 lakh crore disbursement is yet to happen. I'm expecting that some disbursement will happen in this quarter, and then going forward in 26-27, most of these disbursement will start happening. So we have a good pool of corporate loan book, and these are not the proposals in hand. These are all the sanction book. So going forward, I'm expecting that we will be closing the corporate loan book at 4 lakh crore in this financial year. So we have a good pipeline. What we are doing is that we are setting away some low yielding advances with some good proposals which are in pipeline. So that is the reason real impact in the corporate loan book is not reflecting. Our corporate loan book in this particular quarter is 8.9%. But I'm expecting that with the calibration which we are doing it, I think with that we will be able to touch the double-digit growth in the corporate loan book.
Mr. Chandra, hi, good morning. Prashant here. In the morning we had the management of CET and I was asking them about whether credit growth is really going to come back in a big way. Because at the end of the day, that is, sort of almost one-to-one kind of injection of liquidity, creating demand, right? We have fortnightly numbers. Is demand for credit? What's your own forecast, sir? Are we going to see an acceleration in terms of credit growth overall, as you see it? And which segments should we focus on? Where is this going? Is it going to home loans, autos as a segment? Where is it going?
See, overall, I can tell you with confidence that there is a vibration in the entire economy. And that number itself reflects if 8.2% is the GDP growth in the Q2, I think definitely that impact is going to come on the credit delivery. If I can talk about our growth in the various sectors, see if you can see our MSME growth. In Q2 also it was more than 19%, and in this quarter also we have shown a growth of 19%. And you know that MSME has the larger impact in the overall economy. So if that is growing at 19%, so it says how the economy is behaving now. Second aspect, if you can touch, is the retail loan. Retail loan is also in this particular quarter, excluding IBPC, we have grown at more than 18%. Housing is growing at more than 15%. Vehicle loan, there is a growth of 35% YOY. So you can see the impact of the GST in this particular quarter. And this is not the story for 1 or 2 quarters. It's going to happen in the entire year to come now. Even our the agri sector, which used to be at 7 to 8% 1 or 2 years back, now that is growing at 11 to 12%. So entire retail, agri, MSME is growing in the double digit and more than 15-16%. Corporate loan book, which everybody was thinking that nothing is happening in the corporate side, if that is growing at 8.9% in this particular quarter, despite setting off some low-yielding advances, and if we have sanctioned 3,12,000 crore of corporate loan book, that speaks about the visibility and speaks about the resilience and the growth in the economy now.
Good point, sir. With regard to the corporate loan book as well, coming back to life, encouraging not just for your company, but for the economy on the whole. Got that. Let's talk about your ROAs, holding around 1%, but some believe maybe it's driven partly by treasury gains. Maybe it's driven a little bit by recoveries. The point is that, going ahead, do you believe the ROA at around 1% is sustainable? Do you have enough levers in store? Please go ahead.
Yeah, I'm fully confident. And the ROA guidance in the very beginning of this year, we had given that we will be maintaining more than 1%, and we are holding to that level. See, in this particular quarter, you are right that one treasury gain that came by Canara HSBC, which we had diluted. But at the same time, 952 crore we got out of that. But mindfully, keeping that profitability in mind and the cushion for the ECL, we have kept 955 crore floating provision. I think everybody should see from that angle. See, this quarter, we have made a provision of 1,343 crore. Now that 1,343 crore is not for the NPS. 386 crore is only for the NPS. Remaining 955 crore is the floating provision, which we have kept it for migration, which is likely to happen in the ECL from 1st April 2027. And with this quarter addition of 955, we have the floating provision of 1,775 crore in the bank now. So you can imagine that likely impact which we have calculated for the ECL for entire transmission is around 10,000 crore for the entire 5 years. And we are already holding 1,775 crore in our kitty now. So not only for this particular quarter, but going forward for Q4 and 26-27 financial year, we are very confident that ROA will be holding more than 1%. No doubt about it.
Mr. Chandra, we'll leave it there, sir. Thank you very much for joining us. Good luck. Very confident and very positive sounding commentary coming from you. And we hope, next time we speak, some of those numbers, of course, hold strong and get stronger. and there is general overall credit acceleration as well. I mean, works for banks, but I mean, of course, critical for the economy as well. We'll take a break. We have the management of Hindustan Zinc joining in the third quarter numbers. Stay tuned, coming up.
Welcome back. This is Corporate Radar, and numbers are trickling in thick and fast. So let's get straight to our next management, Hindustan Zinc. We're joined by the CEO, Mr. Arun Mishra, who joins us on the show. Hi, Mr. Mishra. Always good to have you on the show, sir. Let's talk about the one that's been twinkling the most, silver prices. In the last 1 year, the silver estimate that we were talking about has gone from $35 to $45 to $50 an ounce. Now, Mr. Mishra, you've kept upscaling this guidance. Where do you think silver is headed from here?
So we are not at all now no longer talking about silver price, because beyond a point you cannot do a guesswork and make it a part of your plan. So we are now focusing more and more into how to increase our production of silver. As you can see, in Q3, we have produced 10% more silver compared to Q2. We are unleashing all improvement activities that we required for either producing ore with better grades of silver from our mines, or in the concentrator produce lead concentrate grade with higher ppm of silver. Look at our fumer operation. We have already added 8 tons additional silver through fumer, and we want to add further in Q4. At least double that quantity we'll be adding in Q4. And also look at more stable operation of our pyro plant, from where we get the basic input material for silver. So that is the main lookout now, how to increase more silver from the mining that we do. Otherwise, on the prices, we have given up. We won't calculate or bank too much on prices now.
Okay, focus on production, not on pricing. But you'll hedge some part of the silver, right, at lower prices. So as of now, how much is still pending?
So I think in around 60 tons or so, I will send you the actual number. Something around 72 tons we had hedged in the 9 months. And some amount of that will be left now.
Okay, so some part of that is still in the system, which will gradually get cleared out. But is there any fresh silver sales that have been hedged?
No, we have not.
Okay, all right. Well, let's get to the production side, since you're saying the focus is on production as well as, on the quality of the product. Silver production. The guidance looks like a very, very tall ask, sir. Your 9-month performance, is lagging actually. Are you confident of ending the year at around the 680 tons odd? Because as of 9 months, you're in the vicinity of around 451 tons.
So while the way to look at it, although we have produced 451 tons in the 9 months, but also look at about 21 tons of additional silver value we have recovered from the concentrate sale that we have done. And we want to sell some more concentrate in Q4. So while we keep producing from the smelter finished silver, also we'll recover silver value through concentrate sale. Two together should take us to our guidance number.
So you believe that you're going to be heading closer to 680 tons. But does the demand-supply gap for silver globally continue to exist? Because you've been talking about the deficit.
I think the deficit is there and the demand is continuously increasing. Whatever happens in the US policies, but the world is continuously seeing push for more and more renewable power, and which is pushing up the silver demand and hence the silver prices. I think the equation is not going to change in any short span of time. Only it may correct to the extent that people are overestimating the future prices. To that account, it can correct itself. Otherwise, I don't think the basic factors of demand and supply equation is not going to change much in the coming days.
Okay, got it, Mr. Mishra. But if you could help us out now with the larger part of your business, but of late we're focusing more on silver. So let's talk about zinc. What's the outlook on zinc prices? And could you tell us, is there some more scope for improvement on the cost of production side, which has come down to multi-year lows?
We will do even better than that in Q4 surely on the cost front. But on the price front, overall zinc prices are stable and it will remain at that unless we find new zinc mines expansions happening. Now expansions, even if we or others do, it will take at least 2 to 3 years. So I don't think that the prices are going to vary much in the coming months.
Okay, all right. Mr. Mishra, you have announced phase 1 of the expansion, but the next phase is also awaited. Could you tell us when is that announcement likely?
So phase 1 already we have started working on the ground, and the phase 2 portion, I won't call it phase, it is the balance portion of the expansion of another 650 KT smelter and another 200 KT lead smelter plus some 600 to 700 tons of silver smelter. So all that are on the drawing board. We are finalizing with the designers. By I think a month or two it should be announced.
We hope to touch base and at that time in the next month or two when you announce the incremental capex and the expansion. Now, given that you're going to be generating very, very cash flows, could you tell us what is the utilization of this money?
No, as far as we are concerned, we need about $4 to $5 billion for all our expansion programs, and we want to self-fund that. Unless, of course, the board decides for some strategic purpose. If that not be the case, we want to remain debt-free and utilize all our cash for our own expansion.
Okay, but don't you think it's an opportune time actually to go ahead, unlock value in Hindustan Zinc, maybe separate the silver business?
No, I think in the right places we are discussing, and I am sure when people see the reasons, the decisions will be taken. Right now, I cannot comment on that, but yes, we have raised that topic.
Hoping for a breakthrough, sir. Last few quarters, you have been telling me the same thing. Finally, since you're on the board as well of Vedanta, what's the sense? Vedanta sells some more stake in Hindustan Zinc and, gets a little bit more money power with them?
No, I won't comment on that because that's for the Vedanta to decide. Today, as Hindustan Zinc CEO, I am not going to comment on that.
Got it, Mr. Mishra. Always a pleasure talking to you. Thanks a lot for joining in. Quarter 3 was strong, and going by what you're saying, quarter 4, in all probability, will be even stronger. Stock holding more or less flattish. But we need to address the flashes on the bottom of your screen. Vivek is joining us to give us an update with regard to restaurant brands. Vivek, take it away.
Well, that's right. So on November 24th, our viewers will recall that CNBC-TV18 was the first to report that a family office of a large listed Indian pharma company was in the race and was leading the race to go ahead and acquire a majority controlling stake in Restaurants Brand Asia. In fact, we had also reported that they were looking to completely buy out the PE partner Everstone Capital. What we understand from our sources today is that Ajanta Pharma is the pharma company, and one of the promoters, Ayush Agarwal, who has interest in the QSR space, the family office led by him, is leading the race, and we understand that they will buy out the entire stake of Everstone. In fact, we understand that this is going to be a 3-part transaction process, and we understand that close to 3,300 crore worth of deal will actually happen. Now, what we understand is that in the first step, Ayush Agarwal's family office will look to infuse close to 1,500 crore via cash, and they will take equity in Restaurant Brand Asia. And remember that there is a board meeting scheduled later today for a fundraising as far as RBA is concerned. We understand that step 2 of this particular deal will involve Ayush Agarwal picking up the entire 11.26% stake for close to a little over 450 crore from Everstone Capital. And we understand that since there will be a change as far as the controlling stake in RBA is concerned, we understand that there will also be an open offer, and we understand that this particular open offer will be done at a premium to the current market price. We've reached out to Everstone Capital, Restaurant Brand Asia, Ajanta Pharma, as well as Lennox Foodberg. Responses are awaited from all of the stakeholders involved in this particular transaction.
The Restaurant Brands Asia as a company, I think it listed in 2020, Vivek, and I'm just looking at it, right? I think it's never since then. 2020 was a positive year. After that, it's never had a positive year. It's essentially been just a one-way kind of decline through and through. 21, 22, 23, 24, 25. And of course, this year is starting a little better. The stock's up about 7% on the year so far. So, Vivek, the family office putting money into Restaurants Brand Asia and Everstone's 11% goes, and there's a 26% open offer, right? So finally, after all of this, they aim to own how much of the company?
So 26%, in case all of the shares gets tendered in the open offer, another 11% stake, of close to 450 that they are buying from Everstone Capital, 11% stake over there. And whatever, depending on the price of the deal, they are looking to infuse close to 1,500 crore worth of equity in RBI itself. So eventually they will have the controlling premium. And like you mentioned, a couple of reasons, for the underperformance. Number one has been SSLG growth fundamentally has been quite poor. And there has also been the overhang of consistent pairing of stake by Everstone Capital, which has also weighed in on the stock price. But today evening, we should get a lot more clarity. Hopefully, most of the details should be fleshed out and should be up on the exchanges.
Right. Thanks very much, Vivek, for that. So that is a big story. And Vivek, of course, following up in terms of the information he put out earlier, as he said, today evening is essentially the transaction announcement, as we understand. Well, I think we can move on to another bank, and a bank which has done very well. Yes Bank reported a robust operational performance in the third quarter. Net profits rose 55% on a year-on-year basis. Steady net interest income and improving asset quality. NIMs, by the way, went up some 10 basis points on a quarter-on-quarter basis as well. What's the outlook going forward? Prashant Kumar is Managing Director and CEO at Yes Bank. He's with us. Mr. Kumar, good morning. Great to have you with us here. Prashant this side. So actually, I'll come to the loan growth and in just a bit, but I just wanted to start with a NIM question, sir. Sharp improvement on a Q-on-Q basis, which immediately begets the question whether this is sustainable. There is a fair bit of competition for deposits. How will you manage an upward sort of trajectory for net interest margins, and what are targets going to be like here?
So first thing, Prashant, strategically, we were targeting a profitable loan growth. That is first part. Second, we have also taken deep corrective actions on the pricing on the deposit, especially on the saving bank. So our cost of deposit has also come down. And we also got the advantage because of our RIDF deposits are being now coming down. So I think it's a combination of chasing a profitable loan growth, a reduction in the cost of the deposit, and also getting the advantage because of the RIDF deposits coming down.
So where should one anticipate NIMs at? I mean, could you share with us a target, aspiration?
So we are not targeting, but definitely the current quarter would be tough in terms of recent reduction of 25 basis point would definitely bring down the yields on the loan side for the current quarter. And this quarter, there would be definitely a lot of, fight for the deposit, and this is also the fourth quarter. I don't think we would be able to reduce the cost of deposit for the current quarter. So I think because of this, we would definitely try to retain our margins, and then in the quarter one onwards, the upward journey in terms of improvement on the margin would happen.
All right. Hi, Mr. Kumar. Good morning. Good to see you in. What about in terms of growth? Earlier, I think you all were gunning for close to double-digit growth. This quarter, I think it's been in mid-single digits. What's the outlook in terms of loan growth?
I think if we see the quarter two and quarter three, sequentially, we have been able to achieve a 3% growth. So I think we would be able to have the similar growth or maybe slightly upwards, maybe towards 3.5% for the quarter four. So by and large, we would be in the position to reach around, say, 8% loan growth for the current financial year. But definitely next year would be a different thing because we are already made some changes in terms of how we are targeting the loan growth, profitable loan growth. We have reduced our cost of deposit. So some of the asset classes where we are not targeting as of now would be definitely part of our strategy for the next financial year.
All right. The ROA has been gradually improving, and you mentioned in the past that you believe that it will continue to improve from here on. Could you help us out with the target? When do you hit that 1% odd mark? And what are the levers you have in store?
I think 1% ROA is something we were sharing, like we would be exiting FY26 with a 1% ROA. But if you see the quarter three performance, and if you take out the impact of the gratuity, then we are already 1% ROA for quarter three. So definitely the quarter four, we would be exiting at 1% ROA. And as per our earlier strategy, I think FY27 would be a 1% ROA for the full year.
So just getting back to the point about loan growth, while you have guided for 8% this year, it's still less than 10% that you'd spoken about earlier. So what explains the miss versus earlier expectations, and what are the new portfolio additions that you will do to asset classes that will drive FY27 loan growth, and would that be in double digits?
No, I think if you see in terms of retail side, especially the prime home loan and the new car loan, okay, the pricing is very, very competitive, and we don't think with this pricing it makes sense for us to grow on those asset classes. Sometimes just to chase a loan growth, we forget that not only there is a shrinkage of margin, but it would also bring your obligation for the priority sector, depending on what kind of loan growth you do. So I think we have done our maths around this. We would definitely not target these kind of asset classes where yields are so low and there would be obligation for the priority sector, which is also very, very costly affair for the entire banking industry. When we are talking about the next financial year, I think because we have been able to reduce our deposit cost and we would take further actions in the next financial year, I think we would be able to go forward in terms of like affordable car loans, the used car loans, and the business loan.
Sorry, Mr. Kumar, so the areas of focus is passenger vehicle loans and used cars, etc. That's what the focus is, where yields are better?
Yeah, where the yields are better, including the business loan and the personal loans also.
Okay, not the home loans and the other where yields are low and there's too much competition. What about on the gold loan side, sir, Mr. Kumar?
No, absolutely. Gold loan is a very attractive, I would be saying, asset class. Incidentally, we are not there, but definitely this is our part of a strategy. Only thing is like going for the gold loan, first you need to prepare yourself in terms of how you would operate, in terms of security, safety, and the operational part. But definitely this is part of our strategy going forward.
Yields are also attractive. So this is FY27, we will see this getting rolled out across branches?
Yeah, we will be planning for that.
All right. Talking about FY27, sir, what about your tenure as the head of the bank? I think it ends in April 2026. Any further update with regard to an extension? Leadership is something that the market as well will be looking forward to very, very closely. So what's the latest?
No, I think board is moving forward in terms of succession planning. And I think once there would be a clarity, we would be definitely share with all of you.
Okay. Well, I think, the bank's done very well under your leadership. As you said, ROA is almost 1% now. I really appreciate you joining us here on CNBC-TV18. Thank you very much. We'll take a quick commercial break here. Manisha joining in with commodities in focus on the other side. Stay tuned.
Welcome back. Let's talk commodities now. Manisha is joining in. And what do you have your eye on? One commodity or everything's up and down?
Well, I'm looking at base metal prices. Even as the safe haven buying in precious metals has continued, it is the base metal prices which has finally come under some profit taking. Well, the dollar index for one is holding around 99. That has been putting pressure on prices. The other thing is this whole US and Europe conversation or the friction that we have seen come in really seems to be bothering this sector. So US has threatened tariff on 8 EU nations, 10% from 1st of Feb and 25% on June if the deal does not go through. EU, in the meanwhile, has threatened activating anti-coercion instrument therein. There also is a conversation that you could be looking at meetings coming in the next few days between these 8 European nations there. Europe now, remembers, holds nearly $10 trillion in sense of US bonds and equities. Europe also has a lot of public sector holdings within US in various areas. And if the trade dispute intensifies, Whether or not the European Union will use these holdings to its leverage is what really seems to be bothering the markets right now. Having said that, it also is about a strong number of around 93 billion euros, which Europe faces in sense of levies worth of US goods. So these numbers are leading to not too much of buying now in case of base metal prices therein. Interestingly, it also has been about China growth expectations, which in recent days has been supporting metals, manufacturing, industrial goods. All of that data from China has come in on the positive side. The US, ex-US market tightness, because remember, the US was putting all of these tariffs. So before these tariffs came into place, a lot of metals from various geographies in the world had started going into US. So US was well supplied, but the rest of the world was looking at tightness. But all of that seems to be changing at this point in time. Markets do believe that this rally at these current levels is more speculative, more money-driven than fundamentals. One, the reasons for that is one, that the metal is rising on potential future demand. The current demand is not so strong to keep the prices where they are. Second point is that while the US inventories are well supplied, the ex-US inventories seem to be rising as well. And then US has decided not to tariff the critical minerals. So whether it's about silver, copper, other metals will not be tariffed. So even as there are no tariffs right now and there's enough metal available, the prices have continued to rise. So markets believe some profit taking is what you can perhaps look at in metals in coming few days there. Most interestingly is this point. Shanghai has now prohibited a section of high-frequency trading firms from entering the market, making it speculative and volatile. With these firms not allowed starting today, you're looking at volatility, volume, and the price rise, all of that kind of contained. So the tin prices, which hit an all-time highs, have come off by 10% from those highs. We also have seen aluminium Shanghai inventories gain up by 30% in the matter of last 3 months itself, taking the prices slightly on the weaker side. And there's an inventory increase on LME for copper and zinc as well, weighing onto those commodities there. We are looking at many of these metals actually open in the Asian markets, 0.5 to 1% on the lower side. So finally a day when you're looking at profit taking in base metals.
All right, Manisha, thank you very much for that. So some pullback, and we got a bit of a pullback in equities as well, 117 points. And as we kind of sort of, take a break, I just want to highlight that the rupee has gone past 91 against the US dollar. We'll have a flash coming up in just a bit from now. I think this is the first time since 2017 that we are back at these kind of levels. Yeah, there you go. So dollar rupee 91, past 91 for the first time since December 17th. Okay, so more on this as we go along, but that's a 14 paise depreciation so far coming through. We'll take a quick commercial break here. We'll come back Indianomics with Lata. She'll talk about the budget math with economists Sonal Verma of Nomura, Pranjal Bhandari of HSBC, and Upasana Bharadwaj of Kotak. Stay tuned.